Welcome back. Still with me in the studio, Chris Gilmour from Absa Investments. We're talking about the Eurozone and the crisis in that zone and where you could possibly look at investing during that time of crisis. Chris, the bond markets in Europe must be something that you should be looking at because some of them are looking relatively good at this moment.
Yeah, and look, again, it all depends on your time horizon, your risk appetite, what level of risk you're prepared to tolerate. And,
well, I suppose if you're going to go into Europe, you're going to be somebody who's going to say, right, I am prepared to take risk.
Yeah. I mean, we're talking about, in the main, the old developed world. And it is going to, as we said before in the preamble, it's going to take a long time to come right. But if you do believe that it is going to come right, I mean, we know the relationship between bond yields and bond prices. As yields come down, bond prices go up. So if you're looking for the...
go back on that now. Explain that to me.
Basically, as the interest rates come down, the price of the actual underlying asset, the bond itself, goes up and vice versa. So, for example, if the price of a bond is coming down, it means your yields are actually going up. Okay? So if you look at Greek bonds, for example, now they only really quote theoretical yields in Greece because no one's actually going to buy this stuff at this point in time. But 1 year bonds in Greece are currently trading at about, 30%. So, you know, if you were able to buy these things, then, and you wanted to ride the wave, you know, as the bond yields came down, although you'd be locked in at that level, then the price over time would actually increase. So yes, I mean, as I say, unfortunately, these are kind of theoretical. You're not going to find anyone who's actually going to quote you on that. But these would be the kind of theoretical prices you would pay for a 30-year bond yield in Greece.
Okay, well, let's not talk theory. Let's talk practicality here. What should we be looking at between you and me? Chris and Jeremy, we decide now we're going to invest. Come on, Chris.
Okay.
Right. I'll put R1 million on the table. Don't know where the hell I'm going to get it from, but I'll put R1 million on the table. What are we going to do with the R1 million?
There's lots of things you can look at. I mean, from a South African perspective, if you want to look at markets, for example, in Europe, you can do it without taking your money offshore. You can actually buy things called DBX trackers. So, and what they do, they're exchange-traded funds, ETFs, that have an underlying index in Europe, for example, or the States or Japan or wherever. But we're talking here about Europe. So you would buy the Euro Stoxx 50, for example, which is a bunch of indexes, equity indexes in Europe.
So that's like a Satrix 40, but in Europe. In Europe.
Precisely.
Okay.
That's exactly what it is.
So it's the top 50 shares traded on what? The combined exchanges of Europe?
The Euro Stoxx, I think it's Paris and Amsterdam and one or two others in there.
Okay.
So, you know, you could do that if you're taking a bullish view on the markets there. Look, unfortunately, the developed markets in the world, be it the US, be it the UK, Europe, they've been pretty dismal performers in recent years. I did a presentation the other day, and we actually showed the S&P 500 in the US as a proxy for the developed markets. And in fact, in the past 12 years, they've gone nowhere but south. And in real terms, they're about 30% below the CPI. So, you know, if you believe...
Well, then why are you talking to me about this?
Well,
because I put R1 million on the table.
Okay, well, I'm coming
now
to
you're
that.
Already wasting $1 million.
No.
You've wasted 300,000 of my rand. And you're from an investment company, Chris. Come on.
There are certain investors out there. We don't happen to share this view, but there have been, for 2 or 3 years now, a number of investors, investment professionals have been saying, now's the time to get into these developed markets, and notably places like Europe and the UK, for example, from the point of view that they believe that it's so bombed now, and yields are looking so good that it can't go any lower. Well, that could be the case. We tend to take the view that it probably could grind along the bottom for a while yet. But if you believe that now is the bottom, then that's one of your safer ways to try and access it.
Do you think, your personal opinion, do you think it is the bottom? Do you think?
No, well, it may be the bottom, but I think we could grind along the bottom for a while yet. Yeah. Because of the things we've mentioned, because of this grinding austerity that's going to take place in many of these countries. And I mean, if we take the UK as a good example, you've got a coalition government that's been in place for 2 years now. They've got another 3 years to run. And it's going to take all of that time, in my opinion, before they can really get that economy back in any sort of decent shape again. And I think that probably applies to a number of those countries in Europe. One or two countries do stand out. Countries like Germany, for example, in far better shape than most other European countries. So I suspect if you wanted to go into Germany specifically, now might be not a bad time to have a look at it. You know, there again, you've got to start now looking at different types of skills. And this requires the association with a financial advisor in those countries we're talking about. I'm not an expert in that, and I wouldn't want to go off on a bit of a tangent on this type of thing. But there may well be stock-picking opportunities in countries like Germany, for example, at this point in time. Countries that have got good manufacturing bases and good export potential. And the interesting thing here is the export potential we're talking about is probably into many emerging markets.
Okay. Now, we put, I put that R1 million, which I don't know where I'm going to get right now, to be honest, on the table. But you and I are long-term investors, which you would have to be, as you say, because you say it may sort of grind along the bottom for a while before it starts lifting. What about, and I'm just throwing it in here, what about property?
It's funny, we must be mind readers. I was about to say, at this point in time, and countries like Ireland, and a number of people have said to me, why don't you look at Ireland? Why don't you look at the UK? I would say not the UK yet, because I don't think property prices actually fell enough from their hideously overvalued levels. I think.
Do you think they're still going to fall further?
I don't think they'll necessarily fall further, but I think they could stay pretty stagnant for a while yet.
What's a while?
3 to 5 years.
3 to 5 years.
Yeah.
Yeah. Okay.
Bear in mind, if you're buying physical property, you're buying an awful lot of hassles as well. You know, you've got to get a tenant in there to make it worth your while. You've got to look after the thing, have it serviced. You know, it can be a messy situation. And it's like here, you put a tenant in here and you don't like the oak after a while. How do you get rid of them? It could be the devil's own job. So, you know, it's not as easy as it might sound. But I think if you look at maybe some of the other countries outside of the narrow Eurozone itself. I was in Romania last year. I've been there a few times, and people said to me, you know, you should actually buy Romanian property. And it is pretty cheap. You go next door, Bulgaria, it's even more bombed. You can buy big properties for a fraction of what you pay in this country, and South African property prices globally are pretty cheap. So if you're feeling really, really brave, and you want to go into some of these more esoteric countries in Eastern Europe, Central Europe, those kind of places, there may well be opportunities there. But again, you've got to elicit the services of an expert in this kind of field.
Equities market? I mean, if we're going to be conservative with the money that we don't have, right, is it worth looking at something like the FTSE 100, or are those just really flatlining at this stage?
Well, again, I come back to what I said. If you want to go that route, rather do it via the ETF from South Africa. There may well be stock picking opportunities of individual companies. Again, I'm not an expert in this field, so I couldn't really give any sort of indication on that front. Frankly, as a house, we've taken the view that you're better off looking at emerging markets, countries that have come out of this global financial crisis in far better shape. You know, we're talking about in the Far East, even South Africa itself. We reckon there are far better opportunities here than there would be offshore. I'm not saying one shouldn't be diversifying one's portfolio in terms of a normal risk and geographical risk diversification strategy. Of course one should. But in terms of overweighting it and saying, well, you know, this is going to perform an awful lot better than the emerging markets and South Africa specifically, I'm not convinced that it's going to do that.
Okay, I'm going to come back to the question that I seem, and I may sound like I'm repeating myself every single time on the show, but I seem to come back to this one, and maybe it's one of my ways of trying to balance things. But if you were going to be investing in the Eurozone, what sort of percentage of your investment, your total investment, would you be putting into the Eurozone at this stage? If you've got your investments in South Africa, you've got your property, you've got your equities here, what would you be putting into the Eurozone, and in what form? would you be investing that
Phew.
money?
Well, that's a very, very difficult one, because at the end of the day, it comes back again to the kind of risk profile we're talking about, the kind of age of the investor, the kind of geographical spread that they currently may have or may desire. And this, there's not really one size fits all, unfortunately, Jeremy, in all seriousness. You'd have to sit down, I think, on an individual basis with a financial advisor, work out, again, what your risk appetite is, what your age is, what kind of returns you're looking for.
Okay, I'm 48 years old. I want to invest because I think that I've got some money available, and I don't need it and won't need it for the next 10 years. And I think in 10 years' time, the Eurozone will be looking a lot peachier than it is right now. So what do I do with it? There we go. There's the £1,000,000. What do I do with that £1,000,000?
Okay, and we're assuming that has been generated legally, and you've gone through the Reserve Bank process, and
exactly.
And all that kind of stuff.
And I want to beat inflation in South Africa by 2%.
Well, my honest opinion would be I wouldn't put more than a few percent into developed markets at this point in time, and that's just in terms of just a normal geographical diversification of risk. I would tend rather to look at our market here, our equity market, and within that I would look at the resources. I'm talking about the big diversified miners, things like Anglo-American, Billiton. Sasol to us looks particularly good.
Mm-hmm.
You know, okay, the oil price has been a little bit weakened in the past couple of weeks, but that's going to change. And the rand has been actually quite strong in the past few weeks. But I suspect that's not going to last forever. And bear in mind that Sasol is actually more sensitive to the rand-dollar exchange rate, ironically, than it is to the oil price itself. So given that, I would say those three, I would have a nice exposure, an overweight exposure to those kind of things. Retailers, hand-pick. You know, I think there's some great and fairly cheap retailers out there, things like JD Group and Lewis, for example. And there are quite a few other companies out there which look good to me.
Now, you've successfully turned this right on its head, because we said we're looking at investing in Europe. Are you actually saying that if you have money over there, you should maybe be looking at bringing it back?
Absolutely. And we've been saying this for quite some time. We do not see a compelling reason to be invested offshore, other than a few percent, which you would have just for normal diversifying risk itself. Yeah.
Chris,
we don't see the great compelling reason to be there, frankly.
lovely talking to you.
And you, Jeremy.
Thank you very much for your time.
Thank you.
Chris Gilmour from Absa. Hopefully you enjoyed that and learned something from it. I certainly did. We'll see what we can educate you on next week. Same time, same place. Make sure you're with us. Bye-bye.